So the authorities then saw the light and rushed to save the system. They are now throwing any amount of money at it. The balance sheet of the Federal Reserve has expanded from $800 billion to something in the neighborhood of $3 billion in very, very short time. And even then, they can't print enough money to make up for the collapse of credit. And that's why the dollar, there's a shortage of dollars, and the dollar also rose rather sharply. So I would say that, you know, the system will be saved. But the fallout, the effect on the real economy is going to be, unfortunately, very severe indeed. Now, you then come to the questions that you asked. What are the lessons for regulation? Obviously, there was too little regulation. And there's a real danger that we go overboard and swing to the other extreme, as we did in the 1930s, and over-regulate and turn the banking industry once again, put it into a straitjacket, because that's what happened in the 30s. Hopefully this will be avoided. Certainly you do need to regulate. There was an abandonment on the part of the regulators of their duty to regulate. So there has to be more. But one should not go very far or do as little as necessary, because regulations are also imperfect. Obviously markets are imperfect, but so are regulators. And in addition, they are also bureaucratic and subject to political influences. So of the two, actually one should try to rely on the market mechanism to the greatest possible extent. So you need better regulation. The main lesson is that it's not enough to regulate the money supply, because in contrary to monetarism, which is a market fundamentalist doctrine, money and credit don't move in lockstep. You can have credit expansion or contraction with the same amount of money supply. So credit also needs to be regulated. And you have to recognize that actually markets have moods, and the regulators have to counterbalance the mood of the market, and they need to use new instruments, not new actually, instruments that do exist but are not used. And those are margin requirements, minimum reserve requirements for banks, and you have to use them in an active way to counterbalance the mood of the market. So you actually have to tighten, let's say, minimum reserve requirements for banks at times of exuberance, and lower them in times like this when the banks are not willing to lend. So you have to have variable margin and minimum reserve requirements. That, I think, is the main lesson as far as... Now, the other main lesson, of course, is that, in fact, the banks are living with an implicit guarantee from the state that they can't be allowed to fail. And therefore, if they have that guarantee, which has recently been made pretty explicit, then they have to be subjected to regulation. And clearly, the financial engineers made a fatal mistake, because they calculated the risk, but they did not take into account the uncertainty that is associated with reflexivity. Because by definition, that uncertainty cannot be quantified, and the quants always want to quantify. So you had these quantitative models, which were wonderful in calculating risk and value at risk and all kinds of wonderful esoteric instruments. They all left out of account this uncertainty connected with reflexivity, and that black swan that occasionally flies around. So I think that actually answers most of the questions you asked.
Most of, but not all of. You wish to stop here. I thank you very much for this eloquent presentation, and I spare the audience from my own pieces of wisdom, so I open up the floor rather, because we have little time left. So I ask everybody to ask very, very short and very precise questions after, of course, identifying yourselves. Please.